Testing, 1, 2, 3. Godric here, your stock market mentor. I want you guys to give me comments. I can answer stock market questions. Godric here, your stock market mentor. Good evening, September 11th, 2023. I could answer your stock market questions or your investment questions. Not really financial advice because I don't know you, but I can give you my 2 cents. Trades, investments, stocks, shares, options. Give me some comments. Ask a question. I'm just kind of new to TikTok, so bear with me, but I'm getting the hang of it. I'm a mentor, so I teach the stock market, how to retire into the stock market, how to select good stocks and do trades, and build your portfolio, save money over time, build a account that's increasing, ideally exponentially. So, welcome. I can start like with these 5 stocks: Apple, Nike, Starbucks, Philip Morris, Netflix. Those are like on my core 10, which is a list of 10 stocks. I call it core 10. So I teach the focus, right? So you don't have to learn 40 or 50 or 100 stocks. I teach to focus on 10 that you can get behind, that you can not so much trust, but that you believe in. And as far as the product, the service, the direction the company's going, and then be able to buy the shares and ideally get good results, whether the stock goes up over time or if you're getting dividends, share growth, or if you're doing trades like covered call options. So put some comments down and I can advise as a stock market mentor. I will cover these 5 stocks tonight, and I also want to cover some other market data, just stuff that stock traders talk about and investors. I think like coming on TikTok, not a lot of people do stocks, so I kind of like the idea of talking about stocks and investing. Feel free to put your comments below, ask a question. You can always message me. Also, I'm going to come on Monday nights. We'll start with that. Hey, Satan joined. You have your stock market question? Put in the comments. Serge Tanko, welcome. Nadasharim Way, welcome. I'm going to talk about these 5 stocks tonight: Apple, Netflix, Starbucks, Philip Morris, and Apple. And why they're good. There's a few reasons why I think they're like superior stocks, investments. And if you are interested in the stock market, I can go over some details on what to do, how to buy the shares, what platform to use. Like, I like TD Ameritrade. TD Ameritrade is just basically, it's an app. You can download it from the Apple App Store, and they have, of course, offices like nationwide, United States and Canada. Now, TD Ameritrade is good for a lot of reasons, but mainly it's because they have superior customer service, so I recommend them over the other apps. But honestly, like, a lot of them are pretty similar. For example, Schwab is buying TD Ameritrade, so they're kind of equal in the sense that professionalism. But like, don't go with Robinhood. I don't like Robinhood. I don't think that's a good app. I don't think that's a good platform, because you don't get a real broker. You get like email communication like 3 days later, and like if you have a problem with your account, how are you going to solve it? Like with email communication, you want a real broker. You want to be able to talk to somebody on the phone 24/7. Even if you have like $100 or $1,000, you get customer service at TD Ameritrade. That's why they're good. And do I have a comment? Do I have a comment in the comments? I can answer questions. Let's start by talking about. Let's start with Apple. Everybody has an iPhone, or most people do. Well, not really, but like, it's the number one, right? Their Samsung would be like number two. Apple would be number one. Can you guys hear me? So like, what I look at when I pull up Apple, share price 179. So one share will cost you about $180, and 100 shares. The idea is to get 100 shares. You can start doing stuff. Is 100 shares is going to be $17,900. And why would you want 100 shares? Well, at that point, you can start doing a covered call, which is like you own the shares and you rent out the shares to the public for a fee, for a nominal fee or a premium, your fee. You get paid the fee. You're owning the shares, and you're selling that option to the public every month. So like, while a apartment owner can own an apartment and rent out the units for, let's say, $1,000 or whatever the rent is every month, a stock market shareholder can own shares, let's say of Apple, let's say 100 shares or 200 shares, and rent out those shares on a monthly basis to the option buyers for a premium, which is called a covered call position. The premium could be something like 3% a month, 4% a month, 5% a month. Some of these stocks, Apple will probably pay you, honestly, to probably 2.5% a month, and that's a good, because if you're getting 2% a month, think about like if you did it 10 times, and I don't want to say 12 times, because there's situations where the market's not right, or you have to wait because you want to wait for a better price. So I'm not even going to say you have to do 12 in a year. But if you do 10 covered calls in a month, let's say on Apple, and you're going to get 2.5%, that's 25% return based on those premiums. I'll show you more about that later, but that's one reason to have 100 shares, because then you can do covered calls. And welcome, David. I'm the stock market mentor guy right now I'm doing Apple. I want to cover these 5 stocks I have here tonight, but I'm going to come on every Monday, ideally Monday night, and talk about stocks. Not that many people do stocks on TikTok, so I thought that was a good avenue for me. That's what I do. That's my job. I just do trading and investing in stocks. So anyways, $179 for one share, and 100 shares will be $17,900. And with the 100 shares, you can do a cover call. You're owning the shares, and you're writing that call to the public, to the option buyers for, let's say in this case, 2.5% return, and that's going to be like, I don't know, about $300. And $300 might be a car note, or it might be food, or it might be a bill that you have, and things like that. You can pay your bills with that. those trades aren't really absolute because you still have your account can go up or down. Your account can fluctuate, so it's not like there's other things happening, in your account. So it's not like going to a job and getting paid X dollars because your job is ideally it's stable, it's steady, right? Your cover calls. I mean, the stocks by itself, in a way, it's like a roller coaster because one week stocks are up, next week they're down. So your value is it's always changing in the stock market. But this cover call position I want to talk about. More and more. So I think it's one of the arguably a cover calls I think are the best trade you can make in the stock market. And you need 100 shares to do one cover call, and you do get income. It does actually pay you every month to do that. So in this case, 18 grand will give you about $300 income, and let's say it's 2.5%. You can do the math on that. But what you'll do, you'll take 300 in this case divided by 17,900, and that'll give you a percent return, a percentage. Get a calculator. There's different stocks, there's different covered calls, but I'm just giving you like one that I do because I know how to do that, because I do that actual trade. I'm going to pull up the options just to confirm. See, right now I have the chart up. Let me do this too. Volume. Let me talk about volume real quick. Volume on Apple is 62 million for 10 days, and why that's good is you want to have a stock that has high volume, and because that indicates there's a lot of traders, investors in there, and when the stock or the market moves down or corrects or sells off or goes down or even crashes, there's going to be a lot of traders, investors in that stock that's going to buy it up when it drops lower. So that means that there's support, and that's going to save your ass when the market crashes or when the stock dips, because you'll see it just dip and then they'll buy it back up, and that makes all the difference. That's why I never advise penny stocks. Never advise stocks that have a low volume, because you want to have a high volume when you invest. So never get a stock that has less than, let's say, 2 million or a million. Like I would say the minimum is 1 to 2 million a day. If you don't have that, you're at a high risk. You're at a high risk. I wouldn't do it. I would stay away. Apple in this case, 62 million a day, and that's the volume you want before you consider buying that kind of stock. Again, $179 a share. It was up $1 today, up $1.18, which means like if you have one share, that gives you $1.18 value. If you have 100 shares, that gives you $118. Like I said, if you're doing a cover call, you're gonna get about $300, but that's income. They're gonna drop that money into your account. You have to hold that position until the next month. You can do it every month. So write that down in your memory or in your journal. And if anybody can hear me, maybe share my live. Give me a comment below. Give me a like. Appreciate it. Kind of new to TikTok, so I'm just out here teaching. Not sure how everything works, but bear with me. I'm going to come on Monday nights and do stock market with you guys. Right now we're doing Apple. So we got the share price. We got the volume. I don't want to go to options yet. I want to do, let's do 10-year chart. Okay, so before you buy your stock, I want you to pull up the 10-year chart. Why? Because I want you to invest in a stock that has been going on for at least 10 years. And what that shows, it shows that it passed the test of time. It shows that they survived. that they're going to be around. Ideally, if they've been here 10 years, they can be here in another 10 years. We know Apple's been here since like 87, but the 10-year chart, if you pull it up, it has a gradual incline going up from the bottom left to the top right. And that's why you look at the 10-year chart. One, it passes test of time. Two, it shows performance. So you want a stock that's gone up over 10 years, over the last 10 years. And Apple has done that. If you do have a stock, or if you invest in a stock that's going down over the last 10 years, or was higher 10 years ago, I would definitely avoid that stock, because I understand investing in a stock that loses money, but who can really like put their hard-earned money into a stock that's going down over a 10-year period, or that's going down over a long period? You're losing money. There are what you call like buying at the bottom, but in this case, no, not over 10 years. You'll have downturns in the stock, you'll have corrections in the market, but over a 10-year period, you're going to want to see that stock has moved up. I have her Apple about maybe $17 10 years ago, and now $179. So 10 times, it had a tenfold return, 1,000% return. That's why you want to look at the 10-year chart, because it'll show you how your stock has done, how it performed over the last decade, and if it can do that, likely it'll be here in the next 10 years. That's the theory. It'll keep going. If you invest in a stock that's 6 months old, or a year old, or 2 years old, just be ready for that stock to collapse, because a lot of stocks don't make it. A lot of companies, as you know, like Apple, for example, is like one in I don't know, 100,000. I mean, thousands of companies have come and gone before Apple, while Apple was here. So Apple has proven itself as a proven test of time. It's proven performance. It's going up tenfold. It has volume, like we said. It has a good share price. Oh, share price. Let's talk about that. So I don't want you to buy a stock that has less than, let's say, 50 or even 100. Like between 50 and 100 is a good share price for a lot of reasons, but mainly like it indicates excellence. A high share price indicates excellence, quality. Think of it like high price bottle of wine, or an aged bottle of wine. It's thought of to be better. So Apple at 179 is better than another stock that's like $7 or $17. It just is. It's perceived to be great. Kind of like Princeton or Harvard. They're expensive. So are the good stocks expensive in the stock market. So that's like a perception, and generally it's true. Like almost all the stocks that are priced higher, at least about $100. There's a reason that they've gone up and up to get to that price. So that shows performance. If you're looking at stocks at $3, $4, penny stocks, honestly, for one, you're gambling, and not in a good way. But for two, you're buying like garbage. I mean, honestly, like, I don't want you to, be offended, but like if you give me a stock and I'm going to pull these up, you look at the 10-year chart, look at the volume, look at the share price, I'll tell you if it's garbage. And don't be offended, but there's standards, right? We have standards. And hello, Swizzle has joined the live, and send me a message so I can see if I can get messages. Share my live. So we're looking at different criteria: share price, 10-year chart, volume. Also, like, can you buy the service, or can you buy the product? Like, a lot of people will try to hear about this company. My father-in-law told me about it. I heard it on the TV. And they're going to buy this stock, and they can't even buy the product or service. Like Apple, obviously, people have iPhones, and you can buy the product or service. So that's a good sign. If you cannot buy the product or service of your stock or your prospective investment, I would probably avoid it because that's not a good sign. Can you if you can give me a question in the comments, I can answer. I can try. I see. Welcome Edison. Welcome Gaming Clips. Thank you for liking my live. Give me some likes. So what else? Let's look at Nike. Nike's an older company. NKE symbol. $96. $96.79 down 88 cents. Like, this is kind of thing where these stocks are pretty steady, stable, so they won't go up that much day to day, but like more like year to year, they tend to go up. I'm gonna pull up the chart for Nike. 10-year chart is pretty good. It goes from about 40, maybe 35 to 96. So let's say 3 times. It went up 3 times in the last 10 years, threefold. Okay, I can see that you put stock. Moderna is a good stock. Well, let me look at Moderna. Do you have the symbol? You have the symbol there. I know Moderna does vaccines. So looks like symbol's MRNA. Wow, what a symbol on that one. Let me pull it up for you. Let's see how MRNA. And Moderna is 105 per share. They're down 184 today. So the share price is there. They started in 2019, so that is bad because they're new. So 19, 20, 21, 2, 3. So basically 4 years old in the sense of the stock market. They're 4 years old. They've been trading for 4 years, and they're basically new. However, I have a price of around $10 starting. So they're up to $105.80 today. So basically, you've gotten a tenfold return in 4 years. So that is great. Obviously, they have the patent and the government agreements to make vaccines. So they have like cash flow there. So I know you can buy the product. We talk about buying the product. They do have a big influx in 2021 in, let's say, June. They went up to about 300 and almost $400 a share. And they're down to 105. So, roller coaster ride, I don't like that so much because it can go up and down really aggressively like that. So this is like a newer company. Let me look at some fundamentals. Let me see the summary. I know they have the volume. Volume is 2.8 million. So they got the volume. They don't have the 10-year chart, but they have made money. They have a share price 105. That's good. Who knows what they're gonna do? But I mean, it's decent. It has some of the criteria. Let me see if they're showing a profit. PE. I have a PE of 39, so they do show profits. So that part's good. They got profits. They got a increase in share price. They have a good share price, 100. They have the volume, market cap. They're worth 40.3 billion market cap. What that shows me is that they're not small, but they're not big. So it's good because they have room to grow. If I look at like Amgen, I'm just comparing Amgen to Moderna. Okay, this is why I'm gonna show you this. Amgen's an older company, pharmaceuticals. Amgen is market cap 140 billion. So they're like almost 4 times the size of Moderna. So bigger. And their share price is 261. So higher share price, bigger market cap. PE is 14. So they have a lower PE, which is perceived to be a higher profit per share than Moderna. I'm gonna look at the 10-year chart for Amgen, and it hasn't. I'll tell you right now, it hasn't gone up 10 times. I had a price of about 110 10 years ago, 2014, and now we're at 260. So about 2.5 times return, 2.5 fold on your return on Amgen. So Amgen has a 10-year chart. If you guys pull up Amgen chart, you'll see that it just goes up real steady, and that's the kind of thing you want, like for a long-term investment. You want to have a company that is going to go up over time, and that's Amgen. I can't tell you where Moderna is going to go. They may get more government contracts, but I say we can wait and see. However, like if you were that person that sold Moderna when it was 400, 103 something, you made great money, you made great profit. So like I said, if you want to trade that roller coaster, Moderna. If you want long-term growth and stability, go AMGN. Amgen though won't give you good covered calls as far as I know, because they're not going to pay that premium for the option. It's going to be lower, like maybe 2%. I like to get at least 3% for my cover calls per month, and that means you're getting income per month. You're getting 100 shares of the stock, and you're writing a cover call every month, and you're getting 3%, 4%, 5% return. And write that down in your memory or in your journal, covered call position. And I like to do my cover calls every month. So if it's September now, I'd like to write October. In October, I write November. I'm going to write in October because it's already in the middle of September. But it's about a 30-day trade. Maybe, let's say, between 3 and 7 weeks. So I like to do my cover calls between 3 and 7 weeks, getting around ideally 4% return. And with that, I'm getting income on my money, but also the ability to get some share growth. So like, for example, if I have, let's go back to Apple, AAPL. Apple's 179. So if you're writing Apple cover call, you're going to put 18 grand aside, buy 100 shares of Apple, write next month's cover call, and you're going to get around $300, $270. You can put a limit order to get 300. It'll probably take, but like right now, the one I'm looking at is showing $270. So that's your return. That could pay like maybe a car note or a bill, food bill. Look at your bills and see. I like to look at my bills and see what I can pay with that cover call. If you're going to retire into the stock market, you want to have some income from your investments. You want to have your bills paid, and the cover calls is a good way to do that. And if you're going to get, let's say, 3% return on 100 grand, that's going to be $3,000. On $1 million, ideally you get $1 million. That's going to be $30,000. So it just depends on how much you got, how much you're willing to invest. If you have 10 grand, that's going to be $300 at 3%. 50 grand is going to be $600. Actually, no. 50 grand at 3% is going to be $1,500. So it depends on how much you have and how much you're willing to invest. These five stocks I have here are good for cover calls: Apple, Nike, Starbucks, Philip Morris, and Netflix. Let's look at Starbucks next. Starbucks. I like Starbucks because I can go there and get like a iced tea or a hot mocha latte. So I know that they have a good product, and for the most part they have a good service because they're all trained to kind of like give good customer service. I mean, Starbucks is like a newer company. Like if your drink is messed up or if you don't like your drink, like just tell them, hey, it's too whatever sweet. They'll redo it. They'll redo your drink, and they won't even charge you. Like they'll just redo your drink because they want you to be happy with your product. So that's one reason that Starbucks is awesome, because they literally want to serve the customer and want the customer to be happy. It reminds me of Costco, which is another good company. You can return stuff there, no issues. They just pay you your money back. They don't even ask you really, like, you can just say, hey, I didn't like it, I don't want it, return. Same thing with Starbucks. They either give you your money back or they'll redo your drink. Okay, $95.67 a share, $95.67, up 39 cents. Again, this one, not a roller coaster, more stable, up 39 cents. Some of these technology companies are going to be like, up and down $5-10 a day, like roller coaster rides. So, like Starbucks and Nike being product companies, they're more stable. They're less roller coaster. Okay. I have the 10-year chart up here. Starbucks started here about $40, and now it's 95. So about 2.5 times return. So like 250% return, or like if it is 40 and it goes to 120, that's 3 times your money. If it goes to 80, that's twice your money. Well, this is 95. So it went from 40 to 95 over the last 10 years. What's good about that is it has a steady incline going up. It has some volatility, which means up and down, but not so much. I mean, Starbucks is an American success story. And over the last 10 years, they did well. So they have a 10-year chart. They are performing. They're going up 2.5 times. They have a good share price, $95. It's higher, so it's more excellent than, let's say, a stock that's $5. The volume, they have volume 5.7 million a day average. So the volume is good. Why? Because when the stock sells off, there's enough traders, investors in there that's going to buy the stock and bring the price back up, and that's going to save your ass. So, yes, Starbucks is good. It has everything. It has volume, 10-year chart, it has share price. The cover call doesn't pay so much, but you can still get money in the cover call, probably around 2%. They have a dividend, small dividend, 2% dividend, 2.23. Tiny, a small dividend, not a lot, but I'd rather have a dividend than not a dividend. It shows that the company is returning money to the shareholders. PE, 29 PE, so that's good. I like that PE a lot, actually. It shows profit. Like, if you want to know if your company's making profit, just look, does it have a PE? Yes, PE, 29, is making profit. That's the basic criteria that they have a positive number. If you have a stock that you look at the P and it's a dash or it's a negative, that's bad. That means they're losing money. And like I said, I get the idea of investing in a company that's losing money, but like how much money really of your hard-earned invested money can you really put in a company that's losing money? Like at some point, they gotta make money. Otherwise, you're wasting your time, wasting your money. So Starbucks has profits, they have a PE, they have a volume, they have a 10-year chart, they have a dividend, they have a nice share price, they have everything. However, I'm going to tell you this. Starbucks is not so exciting because even though it's gone up 2.5 times over the last 10 years, that honestly is not great. It's good. It's a good, solid company, yes. But if you look at stocks like Netflix, Nvidia, Tesla, then you're not talking about two times your money. You're talking about 4, 5, 10 times your money. And that's where it gets really exciting, you know. However, those are more technology. They're not consumables. I like to say Starbucks is a consumable because you can consume coffee, right? Whereas like Apple with the iPhone, it's not a consumable. It's a product. It's a technology product. So a little different. And technology, for whatever reason, they tend to have more capacity to go up in price and to double, triple, quadruple, crazy returns. Apple's not the classic technology stock because it's so big. Matter of fact, Apple is the number one company. It's going on $3 trillion market cap, which is huge. Did I tell you that? But so it is the biggest stock, but also it's a technology stock, so it is perceived to be a hot, vibrant, volatile company among the technology that can give great returns. Even though it's big, it can give great returns. Okay, so Starbucks gets maximum stars, but it's not so exciting, and I'll show you what I mean. Again, like if you look at the chart, Starbucks went from $40 to 100. Let's say 100. I was at 100 a couple weeks ago. In 10 years, right? So think about investing, 40 grand 10 years ago. That investment is now 100 grand. That doesn't count the dividends. There are some dividends. 2%, 2.2% means at 100 grand, you're getting 2,200 in dividends. So that is something. I mean, that pays, for a vacation. Like that. All right. Or pay your mortgage for 1 month, right? Let's do Philip Morris, PM. We know a tobacco company, Philip Morris. Now, this one's different because this one's a dividend company, right? So the dividend pays 5.4%, 5.42%. Now that's a heavy, fat, nice dividend. Why is that good? Because if you can get $1 million together at 5.42%, you're going to get 54,000. 5.42. You're going to get $54,200 dividend a year. So why that's important is you can live off that dividend. You can live off your investment. You can just sit there with a dividend stock. You sit there, get the dividend. You own the shares. You get dividends every quarter, every 3 months. Just drops in your account, and you can literally it's like your paycheck. Just hold the shares, get the dividend. Now, dividends aren't guaranteed. For example, they can cut the dividend, they can slash it, or they can reduce it. But like with Philip Morris, I'll tell you, for example, I've been in this company for many years, several decades, and they don't slash the dividend. They don't cut it. They just basically keep adding to it. It actually increases more than inflation. So not only are they giving you consistent dividend, so you could live off of it, but they're increasing the dividend to match inflation, even to beat inflation. And here, like the dollar amount is $5.08 per year per share. per share per year. So one share will give you $5.08, which is, if you divide that by 4, it's like $1.27 per quarter. So again, got 100 grand, you're gonna make 5,400 dividend. Got $1 million, you're making 54,000 income in dividends, and that's important because you can live off that money. Some people got 10 million, then you're making 500 grand. At that point, you're doing good. So the point of me telling you all that about dividends is because if you look at the chart, it doesn't have much increase in the chart. I have a price of about 90 10 years ago. It went all the way to 110, down to 70, and back up to, in this case, 94. So the chart's consistent. It's not going up like crazy, like Starbucks, like Apple did, like Nike did. It just basically maintains, and that is a good sign of a dividend stock. Not really roller coaster ride, more of a stable, steady investment. Getting your 5% dividend. That's all. That's really all you want for a fat dividend company like Philip Morris. You just want to get a dividend, and you want the shares to maintain, and you're pretty good. Shares do go up. If I put the 20-year, 2008, it was $50. So it has doubled in 2008. But you got to count all those dividends, which aren't counted in that. If it's making 5% a year, if you lived off that money, then your shares have also gone up, so you're doing good. Let's look at some more. The volume on Philip Morris is 3.2 million per day average, so that's a great heavy volume. Like I said, when these stocks dip, you get buyers that are going to bring the stock price back up, and that's going to save your ass. So, Philip Morris has the volume. They have a healthy share price, 94. They got a 10-year chart. It's not going up, but it's maintaining. It went up a little bit, but it's mostly maintaining. They got fat dividend. They got PE. PE is 18.12. So the PE is good. That's a good PE, 18. That shows profits. It makes profits. These are criteria that I talk about. Things that you want to consider before buying a stock. I would not do a cover call on Philip Morris. It doesn't pay very much because why? Because the stock's not that exciting. I'm gonna show you Netflix before we wrap up, and I'm gonna show you why Netflix is exciting. But Philip Morris is not so exciting. Like if you were investing $1 million, you put in Philip Morris if you wanted just to get that dividend, to have a stable long-term investment, not to make great returns. You wouldn't put it to make great returns. You would put it like, in that case, you put it, I'm gonna show you, like Netflix. Do you do stocks, my man? I welcome the guests up here. Why, if you want, do you do stocks? Speak English? Talk to me. Let's do Netflix, and then we can wrap up. Netflix, NFLX. Okay, $4.45 per share. Wow, like that's a lot. I know that's a lot. $445, up $2.56 today. That means that you need 44 grand, 44,000 to do a cover call. But let me tell you, you can make like, I know the cover calls pay like $1,000 per month, or let's say 3% return. So that's a good reason to get 44 grand, because you can make $1,000 a month on the cover call on Netflix. And $1,000 might pay your mortgage. It might pay, your car note. It might buy you some food. And I teach how to retire in the stock market when all the numbers are right, when you have a portfolio. Welcome, Black Swan. I'm doing stock market trading and investing, and I'm teaching how to retire in the stock market. I come on Monday nights, and ideally we're going to keep going Mondays, so I appreciate you. Okay, so Netflix has a share price 400. Like I said, the higher share prices are considered to be excellent. That's why they're good. They've gone up so high. They prove themselves. So don't be afraid to buy a high price stock. That's my point. Those low price stocks, $5, $10, you want to avoid those for the most part because they're low. The quality is not there. It's like a gold is more valuable than silver. You know, a fine wine is more expensive. That's just how you look at stocks. That's what I teach. So it has a share price, volume. Netflix volume 3.8 million a day, and that's great. That's great volume for that kind of share price. Again, volume is important because when you have a high volume stock, the stock dips down or corrects. All those that high volume indicates a lot of buyers, a lot of investors, a lot of stock market traders that are going to come in and buy those shares when they're lower, and that physically raises the stock price up. That's going to save your ass. Okay, so has the volume, has the share price, has a PE 51. So that's like a high PE. It's considered like highly valued or expensive. But like I said, you get what you pay for, and I do like Netflix here at 445. If I have time, I'll cover Nvidia also. Nvidia also has a similar price to Netflix, 400 something. Netflix gives no dividend. Doesn't have to. You don't want a dividend from Netflix because dividend stocks indicate like it's paying money back to the shareholders. But with technology companies like Apple, like Nvidia, like Tesla, you don't want a dividend because that tends to stagnate the share price going up. So when you have a technology stock like Netflix, or really it's a streaming service, but it's technology, you don't want a dividend. You just want to have what's called a share growth stock, so the price just goes up over time. And let's see, 10 years ago, let's look at the chart. Always pull you up your 10-year chart. I have like $15 in 2014. About let's say $20. So now that $20 investment goes to $445. So that's going to be 20 times your money, 22 times your money. So like if you put $1,000, it becomes 22,000. That's why Netflix is good, and that's what a technology stock will do over 10 years, or over the long haul. It'll times 10, times 20. Apple was 9 times in 10 years. Netflix is 22 times. So like think about long term. You can multiply money times 10, times 20 in these companies. So Netflix has a 10-year chart. They have the share price. They have the PE, and the PE shows a profit. Market cap, 197 billion. Now, that's big. It's not huge, but it's big. Now, something interesting. Netflix is in the entertainment industry, and the entertainment company of the past was, or even the currently the big entertainment company is Disney, but Netflix beat Disney for market cap, so that's important to know. If I pull up Disney, which has Disneyland Florida, Disneyland California, they have a movie streaming service DIS. Disney market cap is only 151 billion, right? So Disney old school 100-year-old company, 151 billion market cap, but Netflix, who's also technically doing entertainment, is 197 billion. So this is important because you have a newer technology surpassing an old world company, Netflix surpassing Disney, and that equates to having a better return for the investors. Disney, let me go back to Disney just so you can compare some. Disney, $82 a share. Like I said, 151 billion market cap. And let me tell you what Disney was 10 years ago. I know it's gone up, but not by much. About $70, and now it's $82. So it has gone up, but not much. Why? Because it's so stable. It's so steady. It just can't grow like Netflix, which is volatile. Netflix is not stable. It's not steady. You'll get more of a roller coaster ride Netflix. I wanted to show you. Right now, Disney's not showing a dividend, but I know it's paid a dividend before, so they probably just cut their dividend. I know they're having some problems with the parks, with COVID. They took a hit with the COVID because they had to close the parks, so they have other issues going on. But Disney is generally a decent company, but not gonna compare to Netflix. It's just not gonna do it. It just can't. Netflix is gonna be like Disney. You have to go to the park. You have to go to the movies to watch a movie. And now all these movies, are streamed to platforms like Netflix. You don't even have to leave your house. So Netflix is considered a new technology, and it's considered better than Disney. I'm trying to show you the mindset why Netflix is going to be a better investment than Disney, for example. So Netflix, yes. Disney, not so much. Disney is great 40 years ago. But now the growth is going to be in stocks like Netflix. That's the difference. That was great, guys. I appreciate you. If you have any questions, give me a comment. I can look up a stock for you. Don't get mad if I tell you it's trash. But we went over some criteria. Share price should be high. 50 to 100. Volume should be 1 to 2 million or more a day. 10-year chart should show an increase over time. Market cap should be, I like market cap to be about 25 billion. But I can do like 10 billion. But I don't want it too small because the market cap is too small. It indicates that the company can, it needs to be able to weather the storm. And we have market cap like 25 billion, 50 billion. That's like a good minimum because I know it can weather a storm. Disney, like I said, 151 billion market cap. Netflix, 197 billion market cap. So huge, pretty big. Like Netflix, for example, they had like 700,000. If I have that number right, Russian subscribers, and because of that Ukraine war, they cut all the Russian subscribers. And they still did good. So it's just one of those things where when you're in so many countries, it's like you have all kinds of business just going every which way. And Netflix is one of those things that it's pretty much worldwide. So that's what you want. I'm looking at if I have comments here. I love to answer questions. I'm going to be on Monday nights. We covered Apple, Nike, Starbucks, Philip Morris, Netflix. We covered those 5. We talked about cover calls. We talked about why volume is important, why PE is important, why a 10-year chart is important. I talked about building a core 10 stocks list where focus on 10 stocks and not 40 or 50 or 100. Focus stocks on your core 10 stocks list are like stocks you can get behind. You believe in the service or the product. These are things I teach to retire you to the stock market. Message me, follow. for more. Ask a question, like, share. Black Swan, welcome. Daniel, welcome. One Aliette, welcome. We just covered 5 stocks. I'm going to come on every Monday, cover more stocks, tell you about investing in the stock market, how to make money. Send me a message if you like. I'll answer your question best I can. Let's just do Tesla, and we can call it a day. Tesla $273 a share. So Tesla can get $2,000 a month on the cover call, or let's just say, I don't want to overpromise. Let's just say $1,500. So Tesla will give you like flat 5% return on the cover call, and that's great. Today, 273 up 25 points. It was up 10% just today. Now that's not a normal day. 10% increase is uncommon, even for Tesla, and it can't do that every day, you know. But like if you look at the 10-year chart for Tesla, 273, which means $273 for one share, but to do 100 shares is 27,000. So not so. It's high, but not too high. Not as high as Netflix. I got like $5 10 years ago, and if it's 22.75, like that's like 55 times your money return. That's like 5,000% return. So Tesla is going to be the winner tonight as far as return on your investment over 10 years, and it has a 10-year chart. So 10-year chart meaning it survived the last 10 years. It's traded. It's gone up. It's proved itself. Okay. Now let's look at some other stats. Volume. Guess what the volume is on Tesla? 125 million. Twice what Apple has. And the share price is also higher than Apple's. Market cap, 868 billion. That's huge. That's just huge. No dividend. Like I said, technology companies for the most part will not pay dividend. You don't want a dividend. You want share growth. You want to buy the shares today and check in 3 years, 5 years, 10 years, and see if they've gone up. And Tesla has done that. Has a 55-fold return over 10 years. $1,000 invested in Tesla 10 years ago has returned about $55,000 today. PE, yes, they make profit. 70 PE. So the PE, interesting, is higher than Netflix, which means it's perceived to be more expensive stock than Netflix, higher valued, higher priced than Netflix. So that's something to think about. What that means is the stock is highly in favor. Like it's just like the investors love this company. They're willing to buy it to 70 PE. A lot of people would say that's too expensive, but as an investor, stock market trader, I'd say that it's just highly priced. It's just highly priced, highly favored, and the price is higher because of that. The PE ratio is higher because it's perceived to be excellent, or it's perceived to be an opportunity. And like in 10 years from now, it could be much higher. Like I think Kathy Wood said Tesla to price to go to 2,000, so it could go up another 8 times. It could. The next time. One Alette came back. Michael joined. Welcome, Daniel. Okay, Tesla, $273 a share. 100 shares are going to cost you $27,000. Cover call on Tesla every month will give you $1,500 a month or 5% return, give or take, and that's great. No dividend, has a PE 70, market cap 868 billion. This is stuff that stock market traders, like investors, talk about. They look at, has the 10-year chart, has the volume, has the market cap. Has everything basically except a dividend, but we don't need a dividend. We want share growth over time. Elon Musk is on board. Speaking of Elon Musk, I think I saw Elon Musk. $269 billion is would it be? Welcome, Swizzle. I just pulled up Elon Musk. It says he's worth $269 billion would it be. At that point, it doesn't really matter. It just is what it is. Like, if he spent $1 billion a year, he wouldn't live long enough to get through his money. Yeah. I wonder. Let's just compare him to what's Apple guy Tim Cook. Let's see. Tim Cook net worth is Tim Cook Apple CEO net worth $1.9 billion. Like, that's nothing. I got the call to go to dinner. We're gonna have to wrap up soon. We can do this next Monday. We'll come back Monday night. Mark your calendar. We'll do 5 more stocks on Monday. We'll do some more positions, talk about stocks. I appreciate your likes and your shares. Godric out. Good night.